In our last session, we talked about corporate level strategy and specifically diversification. Now, one way to achieve diversification is to build a business from scratch. However, this is often lengthy and it comes with a lot of risk because we don't know if our business actually makes it. So one way of making this faster and getting a higher level of certainty is by actually acquiring a business. So today we will talk about acquisition and restructuring strategies. Specifically, we will talk about reasons for acquisitions, why so many acquisitions fail and how to make them successful. And finally, about restructuring strategies. So after we acquire a company, what do we do with that company to get the best value out of it? But before we do that, we first have to talk about some definitions. The first definition is a merger. So a merger is an agreement between two firms to integrate their operations on a relatively co-equal basis. So a merger actually is not an acquisition. An acquisition is when one firm buys a controlling interest, so more than 50% of another company. And the intent and the result of that acquisition is to make the acquired firm a subsidiary. Takeover is a special type of acquisition where the target firm does not solicit the acquiring firm's bid. What does it mean? In a takeover situation, the acquiring company buys out the target firm without the target firm's consent. It's also often called a hostile takeover. So these three terms are often mixed up and confused. So it's important that we have a clear definition at the beginning. Next, I would like to talk about some of the reasons of why companies buy other companies. Why do acquisitions happen? The first reason is increased market power. So this can come from a couple of areas. In the case of horizontal acquisitions, meaning if one company buys a competitor or a company in the same industry, this can be cost-based synergies, so basically reduced costs from the combination of the two businesses, or revenue-based synergies, so finding new revenue pools or new revenue sources after combining the two businesses. For vertical acquisitions, for example, when a company buys into their supplier, there we have control over additional parts of the value chain, and therefore we have margin control, and that gives us additional sources of market power as well. If we have related acquisitions, then we might have an increase in customer base, or because we might use similar suppliers or the same suppliers even, we have an increase in bargaining power with those suppliers. Also, we might use an acquisition to prevent competitors from growing. So either by growing our own market share and leaving no room for the competitor, or by buying the company before the competitor buys the company, and therefore we have a competitive edge over our competitor. The second reason is overcoming entry barriers. So very often companies buy other companies with cross-border acquisitions, so they get immediate market access, especially when there's economies of scale in place or differentiated products. This cross-border acquisition will make it very fast to enter a new market. The third reason is linked to new product development. So sometimes companies buy other companies in order to get access to their new products or to their innovations. And the reason for this is, just to give you some statistics, internal product development is actually costly and risky. 88% of innovations fail, and 60% of the remaining 12% face imitation within 4 years. So this is particularly costly in high-tech and pharma industries. So by buying the innovations or by buying a company that has innovations, already registered products, there's higher predictability and we might get better returns on investment. The fourth reason is increased diversification. So in the previous session, we already talked about the reasons for diversification, and acquisitions can foster related or unrelated diversifications depending on which type of business we buy. The fifth reason is reshaping the firm's competitive scope. So acquisitions might help to lessen the firm's dependence on one product and therefore diversify and reduce the risk for the business. And finally, an important reason is also learning and developing new capabilities. So, for example, by gaining access to the intangible resources of a company, we might gain capabilities that we currently don't possess. And if we need to build those capabilities internally, it might be very long and costly. So by acquiring a company, we might gain these capabilities actually in a faster way. Now, one of the challenges with acquisitions is shown in this chart. Most acquisitions actually fail. Only about 20% of acquisitions are successful. Another 20% are clear failures, where it's a real catastrophe. And for the remaining 60%, they deliver results that are disappointing. There's a great video about the biggest disasters in acquisition and mergers, and I will link this video for you here. Now, why do so many acquisitions fail? Let's look at some of the reasons. The first and foremost reason is integration difficulty. Corporate cultures can be quite diverse. Maybe financial systems don't link up. The relationships between the management or even at the working level don't really work out. And very often there is fights over the status of executives of the acquired firm. And this can lead to a fallout. So integration difficulties is one of the most frequent reasons why acquisitions fail. The second most frequent reason is that there was actually not enough due diligence. And with due diligence, we mean the evaluation of the target firm before the acquisition happens. So in this due diligence process, the company tries to assess the true value of the target firm, how the transaction is financed, what the difference in culture are, tax consequences, and so on. So all the aspects of the acquisition are assessed during the due diligence process. This is typically conducted in collaboration with investment bankers, accountants, lawyers, management consultants. But sometimes it happens that companies don't do this due diligence process very carefully, miss out on important aspects, and therefore the acquisition later fails as a consequence. The third reason is that after the acquisition, the acquiring company ends up with large, extraordinary amounts of debt. This leads to increased cost of debt. So typically you face a downgrading of your credit rating, and then the cost of debt increase, and therefore there's increased likelihood of bankruptcy. The whole cost of capital increase along with this. This acquisition, after or being in a difficult debt position, might lead to not being able to make the required investments in R&D, in HR, in training, in marketing, and so on. And this postponing of R&D investments often has a long-term negative impact on the business. So therefore, in the long term, the acquisition also fails because of the extraordinary amount of debt. Reason number 4 is that there's too much diversification. So especially in conglomerate diversification, or when you buy a company that is not related to your existing business, it is very difficult for management to be knowledgeable enough in the different industries. And therefore, often there's a lack of attention to the detail, and it can make it difficult to control the performance, and therefore the business performance slips and the acquisition fails. Reason number 5 is that synergies that are forecasted or that are built into the acquisition models are often not achieved. Very often it's the main motivation for the board of directors to make the investment, or for the management to do an acquisition. But actually it's very challenging, and very often synergies are overestimated just to justify the acquisition in the first place. And after the fact, it doesn't turn out that way, and therefore the acquisition also fails. Reason number 6 is that an acquisition takes a very large amount of management time. I have to say that deal making, like making these acquisitions, is fun. It's exciting. You deal with new people, you deal with a new environment, new business, new culture. For management, this is really fun. And it involves all kind of management activities like searching for the target, doing the due diligence, which is very time consuming also, preparing and executing the negotiations, and then after the deal is done, managing the integration. So what happens in that process is that a lot of focus goes into the acquisition. And there's a big risk that the managers lose the focus on the fundamental problems of their core business, and therefore the whole business together with the acquisition also fails. And finally, from unrelated acquisitions, there might be diseconomies of scale, especially for unrelated acquisitions. So these diseconomies occur when the business just becomes too large. It's too difficult to manage. And there's additional costs of managing this big company. And they outweigh the benefits of the economies of scale and actually turn them into negative. So this might lead to higher cost. And then eventually the acquisition fails because of the synergies not being achieved, or the economies that were hoped to be achieved from the acquisition actually don't come through. Now, not all acquisitions fail. About 20% of acquisitions actually are successful. So what are some of the elements of those successful acquisitions? The first attribute is when the acquired firm has complementary assets to those of the acquiring firm. If that is the case, then there's a high probability of synergies, including economies of scope and increased purchasing power and so on, and therefore competitive advantage. So related acquisitions, complementary assets is always a very important attribute to make acquisitions successful. The second one is that an acquisition should be friendly. So statistically, hostile takeovers don't turn out so well. If the acquisition is friendly, then the integration is typically faster, more effective, and also it's more likely that the company pays lower premiums on the acquisition price, and therefore the acquisition becomes more affordable. The third attribute of an effective acquisition is to do an effective due diligence to evaluate the target firm's health, so financial health, cultural health, HR. If this is done properly, then you acquire a firm with the strongest capabilities and don't overpay. The fourth attribute is when the acquiring firm is in a financially favorable position before the acquisition happens. If that is the case, if there's some cash in the business, then the financing, like either debt or equity, is easier and is less costly. And the firm doesn't risk to go into too much debt, which is the next attribute. So the merged firm also needs to maintain a low or moderate debt position. Again, this will lead to lower financing costs and therefore lower risk in the long run. Attribute number 6 is that the acquiring firm needs to be focused on R&D and innovation. Now, this is needed to maintain a long-term competitive advantage in markets. And actually, from the research, it is not enough for just the acquired firm to have those R&D resources and this knowledge. This culture needs to be in the acquiring firm already. And finally, the acquiring firm needs to manage the change well. This also means that the acquiring firm needs to be flexible and adaptable. This is not a given because the acquiring firm is usually in the upper hand because it takes ownership of the new company. But the more flexible and open-minded the acquiring firm is, the faster will be the integration and the higher also the likelihood to achieve synergies between the firms. So these were the 7 attributes of successful acquisitions. Finally, I would like to look at what happens after the acquisition. So here we are talking about restructuring strategies. And there are 3 types of restructuring strategies. The first is downsizing. So after you acquire the firm, you might decide to reduce the number of employees, reduce any redundancies between the two companies, or even reduce entire operating units. So shut down entire businesses and gain synergies from this one. So that's downsizing. A second strategy, different strategy, is downscoping. So here it is about divesting unrelated businesses and maybe doing spin-offs. So this is to reduce the complexity of the business. You sell off those parts that don't fit into the portfolio, unrelated businesses. And a third strategy is a leveraged buyout. So in this case, the company might decide to buy all the stock of the company and make it private. So after having acquired like a majority, for example, 60%, the company might decide to also acquire the remaining 40%, take it off the stock market, for example, make it private. And this can lead to a large amount of debt and might require some sales of asset, but it also means that you have the full control over the business. So let's look at how these strategies typically play out, starting with downsizing. Now, in the short term, downsizing brings some positive impact because you have reduced labor cost and you might achieve some short-term synergies. In the long term, there's a risk of the downsizing strategy that it leads to loss of capital, loss of human capital. So when good people leave the business or you lose good people as part of the labor reduction, and therefore this might lead to lower performance. For the downscoping strategy, there's two effects. On one side, there's reduced debt and reduced financing costs because you spin off the company. And on the other side, there's also a positive impact on strategic controls because the remainder of the business, the core business, is actually strengthened by having more focus on it. And this typically leads both together to higher performance. So downscoping strategies, on average, lead to higher performance in the long term. Now, a leveraged buyout, an LBO, also leads to higher strategic control because you take full control of the business, but it also leads to high debt cost because you basically need to acquire 100% of the equity of the business. And as a result, this can lead to higher performance. So some leveraged buyouts actually turn out pretty well in the long term, but it can also lead to higher risk because of the high debt levels. So we have looked at corporate level strategies, diversification, and specifically at mergers and acquisition. In the next sessions, we will talk about more specific strategies like international strategies as well as cooperative strategies.